Let's bring in our guest right now. Stephen Nash is the Head of Strategy and Market Development at FIIG Securities, joining us here in Sydney. Stephen, you're in the camp calling for or expecting no change. What do you make of what the RBA's had to say and this 25 basis point reduction?
Look, I think I'm much in the camp of most economists in the sense that I was expecting no change in policy, but I think the recent data has been a little bit on the weaker side. I think you could describe it as a bit of a dead cat bounce in a lot of ways, post the recent large cut, and also the non-farm payrolls I think really sealed the deal in terms of some sort of rate adjustment. The doves have been having a bit of a field day in the market at the moment, going for 50-point cuts. I think that's probably not to be expected going forward. I think the large cut has been done, and we can probably look forward to a series of 25s going forward towards about the 3% by the end of the year, I'd imagine.
Okay, yeah, that was going to be my next question, because Westpac, for one, is calling for 100 basis points in 25 basis point moves, taking the rate down to about 2.75%. Do you not think it will get that low? Do you see 3% as the bottom?
I think at this stage, given what we can see right now, I think that's probably enough at this stage. It really depends on what happens in Europe, and that's really anyone's guess. We've got the Greek election result coming out soon. There may be cause for further easing if that is a bad result for the markets. I think the RBA is very concerned about developments in Europe and have flagged that quite a few times already.
Yeah, Stephen. You know, Stephen, if the rates do go down to 3%, ultimately we're getting to the levels that we had seen during the height of the global financial crisis. Do you think that would be warranted, especially given that after one too many meetings in Europe, we still never got any concrete results on how to fix the fiscal union, how to fix the banking system as well?
Yeah, look, I think at around 3%, that would bring mortgage rates into a fairly stimulative area. It would support consumer sentiment quite a bit here. We have a bit of a problem with, as the RBA has mentioned, that businesses and consumers are quite cautious. They're trying to break that cycle at the moment, and it's important that we don't get negative momentum in the housing market, and we can have a more buoyant outlook in terms of consumer sentiment. The recent results with regard to consumer sentiment were quite subdued, given the large easing that we did have. So I imagine that we need a little bit more stimulation here, and the outlook in terms of the developed world is not getting any better anytime soon.
Stephen, this is Carolyn in London. Just wondering how concerned the RBA should be about the corporate sector. On Monday, we got data showing that Australian company profits fell 4% in the first quarter, 13% drop in the mining sector. To what extent is that going to drive further RBA policy setting?
Look, I think the RBA is aware of what's going on in China, and they've been focusing on that quite a bit. Now, there have been some comments of late by the central bank governor indicating that the slowdown in the Chinese sector was larger than expected. Regional growth is really important to the RBA. That doesn't mean China's collapsing in growth. It just means there's a bit of a growth slowdown going on. I think that's something that's going to be guiding policy going forward. And a lot of our growth of late has been in the mining sector. Now, if you take out the mining sector and you have a more subdued sector there, overall the economy starts to look quite weak, with the non-mining sector being in a rolling recession for quite a while now. So I think the RBA is beginning to realise that with that regional growth declining, they're looking at what's happening on the non-mining sector, and that's not strong right now.
Just finally, of course, you're a bond specialist. What do you make of the reaction that we've seen to this decision in the bond markets right now? And do you think we might retest those record low yields that we've been seeing on particularly the 3 and 10 years over the last few days?
Look, I think in terms of the local bond markets, come with a bit of surprise. People were expecting a rally, but a rally through 3% on 10-year bonds is probably not what a lot of people have been expecting. 3-year bonds at their level under cash were getting quite expensive, and they still are quite expensive. So I imagine that if there's any improvement in terms of the European situation or the US situation, which very well could be over this week because we have a lot of announcements by Bernanke and others, that those bond yields could rise quite substantially.
All right. Thank you very much for your instant analysis. We appreciate it today. That was Stephen Nash from FIIG